today with a look at the long-term forecast for the global economy. So this is a forecast that we produce in-house at the conference board once a year. You're familiar with our monthly forecasts that look at the next year and the year beyond, but we're looking 15 years ahead in the case of this, the Global Economic Outlook 2026. So we're going to talk a little bit about it. We're going to explore what we envision happening, not just globally, but in specific regions. We'll talk about the US, the Euro area, and China. And I have some fantastic guests joining me today to do this with. So in studio with me is Elena Sholiatyeva, our senior U.S. economist. Thanks for joining, Elena.
Thank you.
We have Dino Pantidis, who is in Brussels. Dino, welcome to the program.
Thank you for having me, Eric.
And David Hoffman, actually my old boss, as it turns out, also joining us from Portland today. David, welcome to the program.
It's great to be here, Eric.
So we're going to launch really right in. I'm going to give an overview of the global forecasts that we've just put out. I'll talk a little bit about the modeling in terms of how we actually accomplish this. We use a different sort of prism, if you will, than we do for our monthly forecasts. And then I'll tease out some of the sort of takeaways in terms of what we expect to happen in terms of the drivers of growth and where we expect it to happen. What we do when we build this model is we use all of the historic data from our total economy database, our TED database that we also produce once a year. And that tracks GDP for 144 economies around the world. And we take that data and we make projections built on top of it. So the data that's in TED, the historic data in all the charts that you're going to see, that's all actual growth numbers that we've seen in various corners of the world. What we're projecting about the future, however, is a little bit different. We're looking at something called potential GDP growth as opposed to actual GDP growth. And the difference between the two is that actual GDP growth is quite volatile. It jumps around from year to year. There's a lot of volatility. But the potential number basically is almost sort of like a speed limit for an economy. Given efficient usage of the inputs in any given economy, you can calculate about what that potential growth rate should look like. And that's what we're looking at in terms of these forecasts over the next 15 years. Also, we use something called a supply side framework in terms of developing all this. So as you all probably remember from econ classes in college or in high school, GDP equals consumption plus investment plus government expenditure plus net exports. That's called the expenditure method. There's ways to calculate it too. Including the supply side method, where we're looking at inputs into economic activity from labor, from capital, and from something called total factor productivity, or TFP. For the capital contribution, basically what we're looking at is a supply of capital to build things, buildings, machinery, software. For labor contributions, we're looking at basically the supply of workers, which is the quantity, but also increasingly the quality of workers as well in terms of their skill sets and knowledge base. And then there's this sort of nebulous concept called TFP. So essentially what TFP is, if you look at the historical data, it's almost a growth residual. So we know how much an economy grew. We know what the capital contribution was because we can measure that. We know what the labor contribution was because we can measure that too, but it grew even more, or maybe it grew a little bit less. And that sort of X factor is attributed to this concept called TFP. And really what it captures is the efficiency with which the capital and the labor inputs are used in the production process. So those are the three pieces that we look at when we're making our projections about the global economy. In terms of our takeaways for this year, they're very similar to the takeaways from last year in many ways, but they also are a little bit different in key ways as well. Overall, we continue to expect a moderation in overall global GDP growth through the end of the 2030s. That hasn't changed from last year in terms of our projections. We continue to forecast a slowdown. A lot of this has to do with demographics and the labor contribution. So there are large sort of structural changes that are happening in demographics worldwide. It's more acute in some economies than in others. China, for instance, has a very challenging time in terms of demographics. Europe does as well. The U.S. A bit, but not quite as extreme, versus some emerging economies, which are actually seeing a sort of a tailwind from the demographic sort of situation there. In terms of capital deployment, we continue to expect to see a fairly decent contributions to growth associated with capital. But the difference is, I think, this year is we're starting to see more productivity growth than we had forecasted previously. There's a lot going on. The TFP numbers typically respond to efficiencies associated with past investments and things like infrastructure. So let's say you built an airport or a port a year ago or 2 years ago, you start to see the gains economically from that beyond just the physical building of it over the years that follow. Another big theme that we're very focused on is artificial intelligence. And it's very challenging to make accurate projections about how that's going to impact productivity, of course. But we've made some sort of simple estimates and factored those into our forecasts as well. But there's a lot of upside potential to that, and even some downside potential, depending on how the AI story plays out. In terms of what this actually looks like graphically, we have two sort of sections in this chart. On the left-hand side, we're looking at historical data. So going back to 2000, what the average annual growth rate was for the global economy over those years. And then on the right-hand side, we have our projections. So again, on the left, we're looking at actual growth numbers that we've seen previously. We're looking at the contributions associated with that. So you can see that, for instance, productivity or TFP contributed about 0.6 percentage point to global growth between 2000 and 2008. That's an average year-over-year number. But it really came down in the period between the financial crisis and the COVID-19 pandemic. We didn't see much in the way of productivity growth, only about 0.1. And a little bit of a pickup for the pandemic period. But again, this is globally, and it varies, of course, from economy to economy. As Yelena will talk about, the U.S. actually saw quite a bit in terms of TFP contributions over the pandemic period. The demographic numbers, as you can see, those are the dark blue numbers on the very bottom, getting smaller and smaller and smaller, which gets to that issue that I spoke to previously about the demographic crunch. And then on the capital side, still fairly decent capital growth of about 2 to 1.6 percentage point over the 15-year period, which is a little bit cooler than it was prior to the pandemic, but still fairly sizable. In terms of where some of this growth will be occurring, we are expecting to see the growth rates for both emerging markets and developed markets cool. So both of them will be showing a little bit of a cool down. Not negative, not zero, but just lower growth rates than what we saw in the 2000s and 2010s. But what we continue to project is that in terms of the overall global growth rate, we're going to continue to see emerging markets in general contribute more to that top line number than advanced economies. And that's what we're looking at in the chart here. So China, for instance, we are projecting, and David Hoffman will talk about this, that China's growth rate is going to moderate over time, over the next decade or two. But given its size, it'll still be contributing quite a bit to overall global GDP growth. India is another one that we're projecting to show fairly sizable growth rates over the forecasted period. Not quite as big as what they had been previously, but it will continue to be a large driver to overall GDP as well. Europe, the US, and some of the other mature economies, increasingly smaller contributions. But we saw that pattern, again, over the last 20 years. It's just going to get more acute. That's not to say that the US is not going to grow or that Europe isn't going to grow. They will. But they're going to make up a smaller portion of the global economy. And you can see that in this chart here. Here we're looking at the breakdown in terms of how much of this is mature versus how much of this is emerging. Starting in the 2000s, we had almost 64% associated with mature economies, but that's shrinking down towards the 40s in the late 2030s. Again, these economies have been growing, but there's just been a very, very rapid growth among the emerging economies. And they're crowding out, to a certain extent, some of the growth at the top line level for the global economy. So that's just sort of a wide sort of angle view of some of the takeaways from the report. I'm going to pivot a little bit now and really let the specialists drill down into their respective regions. So we're going to start off with Yelena. Yelena, why don't you tell us about the U.S.?
Sure. Thank you, Eric. So let's move on and let's look at a similar picture that Eric was showing earlier, but for the U.S. economy specifically. So you mentioned that last year, when you presented this outlook, it was not that different from what we are talking about today. One thing is different, though, and for the U.S. specifically, and I was thinking, what is different? What did we highlight? I think it's immigration policy. And it has been a tremendous change in terms of policy with respect to people coming into this country, right? So we saw a significant contribution from immigration over the last 5 years, particularly in the wake of the pandemic. So that contributed to GDP growth quite significantly and also to payrolls growth. But the situation has changed quite dramatically and over the last year. And we are now incorporating much slower growth in population due to policy change. So, but that's not the main factor. The main factor is really aging of the population. So baby boomers retiring and overall what it means is that we are going to have much lower participation rate in the economy over the next few decades, I think, if the situation doesn't change, obviously. So going back to this chart, we are showing a smaller contribution from the labor component of potential GDP. So you can see that the quantity of labor is really shrinking in the coming 15 years, according to our modeling. The optimistic news, yeah, but please go ahead.
No. Yeah, absolutely. I remember that from last year. That's certainly a development in terms of immigration policy. But I think the productivity numbers are a little bit higher this year, right?
Yeah.
Can we talk about that a little bit?
Positive.
Yes.
Okay, negative, positive.
Yeah.
So I think you're right. Yeah, one positive change has been not only capital deepening, but also the TFP. Like we have seen productivity growth in the economy accelerating. And I think the risks are that it will continue to surprise us to the upside. But it's a big unknown. So let's just hold that thought. And it's really, really difficult to quantify it.
Yeah, I mean, we talked about this a little bit yesterday on a different engagement that we did. We're making assertions about a technology that is very much still emerging. We do not necessarily know where AI is going to be in 5 years or in 10 years. So it's challenging to, assign a productivity number that's very accurate in terms of the yield from that.
Totally, but it's real.
Yeah.
It's real.
Yeah.
On the prep call, right, just before we started the conversation, we were talking about how much easier it has become to share the slides, to prepare to
do the
for
webcasts.
all webcasts and things like that, right? It's amazing. We don't even think about these things anymore. Rewind 5 years ago, it was very difficult. Okay, you would send a huge, PowerPoint via email or something like that. It was much harder. That improves productivity. We don't even think about it. But all these kinds of different developments since, COVID that we have seen in our everyday life, quite frankly, is amazing. And that will continue to contribute to productivity growth. But we have a couple of more slides here. So I would like to talk about aging population a little bit here. So again, this chart shows us a fertility rate, which continues to decline. So the latest numbers are way below the population replacement rate. So it's been the case for a long period of time, but things are actually deteriorating in the US. So we're having fewer and fewer children, whereas we are aging as a population, which is not that different from, other developed economies. In terms of capital deepening, I think the picture is actually quite optimistic. We are going, all the news discussions about data centers, energy efficiency, and things like that, that is really happening as well. So we have seen, after some fiscal policy changes, we have seen a wide adoption of this new technologies and investment into infrastructure. So this chart shows us growth in total fixed asset capital stock, just a year-over-year growth. So we are kind of like, the latest data shows 1.5% growth year-over-year, but I think it's quite achievable to see something like 2.5%, or maybe even higher, the rates of capital deepening that we saw back in the 90s and 2000s when we were adopting computers on a wide basis across the economy. So that should continue to support the capital contribution to growth, and that will remain the key driving force behind potential growth in GDP, I would say. So productivity, you mentioned productivity. This is the illustration of that. So we did see a significant pickup in productivity since the pandemic, and this is just the data speaking for itself. So,
yeah. So you talked a little bit about birth rates and how those are affecting demographics. Can you couple that with sort of some of the changes that we're seeing in terms of immigration flows and maybe what the macro implications are of that over the decade or so that we're looking?
So fewer people are joining the labor force. That's the key implication. So there are a lot of different sectors in the economy where immigrants were, really adopting this and then just joining the labor force in those sectors. So we're missing that part. But at the same time, fewer people are joining the labor force from those who were native born, and that will also slow down potential growth in the economy. So there are some caveats, there are some positive risks, I would say. So another element, so we all talk about AI. We know, we hear about that every day. Certain things we don't mention every day, but they could contribute quite positively into population growth. It's, innovation in terms of new drugs, things that will help us live longer and be economically productive quite longer, so that we could retire later in life. So this is a big unknown, how much, the industry, the pharmaceutical industry, can contribute to potential GDP growth going forward. So I just wanted to mention that because we all talk about AI as the biggest part.
Sure.
Yes, it's everywhere, it's really massive. But there are other things like quantum computing or chemical or pharmaceuticals.
And they could cascade, right,
Absolutely.
as AI gets deployed.
And they connect to each other. They're not just one little piece by piece thing. So they can also, combine, and the combined effect could be quite interesting.
In terms of some of the sort of mega themes with regard to capital deployment in the future, we talked about AI. We're already seeing that show up, right, in terms of data centers, building semiconductor fabs. Our colleague Alex Heil has written a lot about electricity usage, right, in terms of increased demand associated with AI data centers and some of the other types of data centers. But there were other themes as well, right? You have manufacturing fragmentation globally. So, to what extent are our expectations that we'll see maybe increased investments associated with manufacturing or the greening of the economy, right, as we transition towards renewable energy? How much, is that also themes that we're expecting to be a bit of a tailwind for capital deepening in the future?
Absolutely. Yeah. So fragmentation is probably a negative thing if I put my economist head on. But
Just within, I'm just
but
isolating it to
within the
capital.
U.S.,
Yeah.
it's probably a positive thing because you really have to
Yeah.
invest into capacity, into production, into manufacturing if you really want to onshore and reshore all kinds of different things.
But also
So,
there's the higher prices associated, of course.
yeah, let's leave that
aside.
for the Fed meeting later
Sure.
today,
There you
like
go.
the whole discussion about prices. But it is also real. So I think that will probably contribute positively
Okay.
in that sense.
Okay. What about any risks? What are some of the things you're worried
Plenty.
about? Oh, well, and again, not just for 26 or 27, but I mean, like, what are some things that could sort of derail these projections?
Higher cost of capital is one thing that I'm concerned about. So we do hear a lot about, fiscal deficits getting larger, debt to GDP ratios getting higher and higher.
Mm-hmm.
This is a real threat that would increase the overall level of interest rates,
Mm-hmm.
particularly long-term interest rates, which in turn could contribute to a higher cost of capital for companies. And that, to an extent, could put a speed limit to the
Erode
economy.
up that capital contribution.
Absolutely. There are, climate risks. So, yes, we probably hear that on the news a little bit less than we probably used to, but it's real. It's still happening.
Mm-hmm.
So, wildfires, hurricanes, things like that, they destroy a lot of productive capacity. So that's a big unknown how much that could limit the potential growth in the economy going forward.
Okay.
But, there are a lot of positives. And I would say that AI is probably the biggest upside risk to the economy. For now, the adoption is quite fragmented. So it's, kind of concentrated in tech industries. What if we think about like AI adoption in manual labor industries?
Mm-hmm.
So that is still coming, I think. We could make a robot like build something and instead of a construction worker, but it's going to take time. So I don't think it's a 2-year kind of thing. It's more over a 5-year thing, horizon. So that was the positive to finish. And I would like to turn it over to David maybe to talk about China, if you don't mind.
Sure. No, that's fine. We can swing back if we get audience questions about the U.S. a little bit more towards the end. So we talked a little about the global top level. We talked about the U.S. David, what's happening in China? What are we expecting to see over the coming years?
Yeah, well, let me sort of start from the top. Similar to the chart that you both have shown for the global economy and the U.S. economy, the Chinese economy shows a similar picture of gradual downshift, but with some different components at work. You'll notice that capital contribution remains very, very significant. Labor contribution is actually negative, and this is due to demographic effects. And TFP growth, total factor productivity growth, the yellow bar makes a slight contribution. In 2014, you may recall, Eric, we put out a report called The Long Soft Fall in Chinese Growth. And the thesis there was that China was destined for a intractable downshift in growth driven at its core by a productivity crisis. And this was in sort of the early aughts to the early 2010s, where productivity growth, according to some of the estimates that we were making at the time, had actually gone negative. The good news is that productivity growth has turned around. When this new generation of leadership came in 2012, they embarked on a campaign to make Chinese capital investment more focused. They have had some success in doing that, and this has resulted in an increasing contribution from total factor productivity growth. But you'll note that it's still pretty low for a less than mature, emerging, embarking on the transition from emerging to maturing economy that is China, you would expect that productivity growth would be higher. What's important to remember about China is the aggregate. China has some of the world's most leading manufacturing companies in the world. But in aggregate, a lot of the manufacturing is still very manual labor based, is still very unautomated, is still very uninformaticized, to use a Chinese word. So in aggregate, the productivity of the industrial sector is quite low, even though on the leading edge, it's world-class, if not world pacing. So that's sort of the story here. Now, back to your introduction at the beginning, these are trend growth rates or potential growth rates. The actual GDP will fluctuate pretty significantly around this average level going forward. And, China has a lot of difficult issues to work through with its economy as it transitions from an emerging economy to a mature economy. There are a lot of important structural imbalances that need to be addressed and so forth. But my key takeaway from this slide, if I'm a business leader trying to make a decision on whether to place long-term bets on different markets, is what this tells me is that the fundamentals in China, in terms of being able to generate growth going into the long term, are significant and important. And there may be hiccups along the way, but the long-term potential of the market and the economy is positive. One thing I would also note here, though, is if you look at the 2000 to 2008 period and just how high growth was, trend growth was, it's really important to remember that in China, the miracle years, if you will, of the 80s and 90s, and were really incredible, in fact, miraculous. And they were miraculous in the fact that they lifted all boats. All regions, all sectors, all companies, everything grew fast. It was just that some things grew faster than others. And there were a lot of regions and a lot of sectors and a lot of companies that didn't really deserve to grow that fast. They just grew with this rising tide of investment that lifted all boats. And we're now in a period where growth is slowing. And in a slower growth economy, companies have to perform better to survive. And we're beginning to see a lot of unseaworthy boats emerging in the market. And we're going through that difficult transition where conditions of overcapacity and resulting price competition are very significant. So we may have members out there looking at this saying growth doesn't feel like 4 or 5% to me now, and that is because we are in that difficult near-term period of extreme price competition while some of this, excess capacity is flushed out of the market. On the demographic side, I think this is very well known. China's population is aging and very quickly. Its workforce has already peaked. New birth rates are very low. As some of you may know, China last year reversed the one-child policy. So families in China are now permitted to have as many children as they want and are encouraged to do so. I think it surprised the government leadership that when this policy changed, that Chinese families didn't immediately go out and start having dozens of babies. But generations change everywhere, and not least in China. The younger generation is very different from the generation of its parents. They have different aspirations with respect to what they want to do career-wise and lifestyle-wise. And this is a big issue. So we're seeing lower contributions from labor. However, we are seeing a higher contribution in terms of skilled labor. China's graduating more and more more and more STEM graduates, more and more PhDs in STEM fields. But again, back to my earlier point about the aggregate. China's graduating, something close to 4 million college graduates a year. It's a very, very substantial talent pool. The number of advanced degrees in STEM of that base is high and incredibly attractive. But you need to think of the 640 million people that comprise the Chinese workforce, and roughly 2/3 of those have less than a high school education or below. And according to some very good work done by Scott Rozelle and his team at Stanford, economies that have a workforce that is below a high school or above education really struggle to emerge from the middle income trap. So China is graduating a lot of great people and has a fantastic pool, but in aggregate, its workforce is undereducated and aging. So a rather difficult situation there. Investment continues to be the primary growth driver, and there is a lot of concern about the efficiency of Chinese investment. China invests about 1/3 of total global investment, and China's investment to GDP level has been the highest in the world and well above regional peers or regional peers and global peers for close to 40 years. So China invests a lot, and a lot of that investment is not as efficient as it could be. So they kind of throw a lot of money at an industrial plan. Let's take new energy vehicles, for example, and they get 140 startups, and 4 or 5 emerge as globally competitive, and we're seeing that now with XPeng and BYD and other cars that are just beautiful. If you go to China now, you'll marvel in this. They're really beautiful. But there's another 100 other companies that won't ever reach commercial viability, that will need to either fail and exit or be merged and consolidated. So this growth model comes at a significant cost, and that cost is reflected in a high accumulated debt and also high accumulated capacity. The unofficial figures here show that Chinese debt is much higher than this, actually, if you take into account local government finances and the implicit guarantees that the state provides to state-owned enterprises. So China has to manage its debt situation just as the U.S. does, and may be better positioned to do so since its debt levels aren't really subject to international market forces. This slide is to say, really, that China's funding capacity is not unlimited. We don't know what the limit is, but the level of debt that is being accumulated is significant, and the upper boundary here really is the currency value. Returns on investment are low and diminishing. China has invested significantly in infrastructure, as we all know. There's not a whole lot of infrastructure to do. A lot of what China is spending on now relates to climate defense and national market integration, trying to make logistics and transport networks more efficient on a nationwide basis. But returns on investment are diminishing, and meanwhile, the government is all in on a campaign to increase investment in manufacturing. And there's a tension here where the state-owned and state-vested firms are investing and the private sector is really sitting on the sidelines. Logic would hold that we're going to have to see some consolidation in the market before we actually see returns on investment return to global standards. You may have heard of the 15th five-year plan is coming out next year. The contours of it were released last month in a top Politburo meeting in Beijing. The actual plan will be announced in March next year, or should be released in March next year at the National People's Congress, which typically happens in March every year. And the whole plan is around this concept of new quality productive forces. So the government's basic idea here is that previous investment in China was scattershot, very broad-based, and therefore unproductive and wasteful. A lot of it went into the real estate sector. There was a lot of overinvestment in real estate. The idea now is that investment should be a lot more focused on strategic emerging industries and on industrial plant upgrade overall. So I mentioned before that in aggregate, a lot of small Chinese producers are not very modernized, not very efficient. The idea is to lift that and make China a very modern industrial manufacturing powerhouse with a focus on, semiconductors, clean tech, green tech, med tech, biopharma, the new emerging industries, and that this should drive growth going forward. The government has been quite successful over the last 5 years with this campaign. My view would be that it's not enough, that we're going to actually have to see some reforms come in on the sort of demand side of the economy, and also in terms of transitioning the workforce. So I mentioned schooling being an issue where we see some, more and more numbers on the higher education side, but a broad base of the workforce that is undereducated and needs to be brought up for China to escape the middle income trap. And total factor productivity for it to really improve will require the government stepping back a little bit from policy making and management of the economy and letting the private sector play a stronger role in driving market-based competition, so that these R&D dollars that you see in the chart at the left, where China's R&D is increasing at a very significant level, can actually be put to use in the most productive way. There has long been a tension around a state-led economy and state or enterprise-led economy, where state enterprises aren't really using factor inputs efficiently, creating a larger space for the private sector to do this, to really turn around these TFP levels. If we go back to that first chart where China's growth rate was very high and its TFP contribution was very high, if that came at a time where the market was opening to foreign investment in China, and a lot of foreign investors came in and more efficiently used Chinese labor and capital, and the TFP numbers really surged. Chinese private enterprises sort of grew up on the back of that groundswell and were extremely productive, and that's really where the economy needs to go to improve this long-term potential growth rate. Last but not least, I'll talk a little bit about reform. China is very focused on the supply side of its economy, on upgrading its industrial plant. It's very trickle down. The idea here is that, a very strong, globally competitive industrial sector will necessarily yield higher paying jobs and therefore necessarily yield higher consumption. I'm not sure if I agree with that, but the opportunity for Chinese policymakers to structurally elevate consumption is a big one. Consumption remains very low in the Chinese economy. It is structurally impaired. The reforms that would be required to elevate it are doable through fiscal reforms and benefit reforms to the social security system and so forth. They're not on the radar, not now. We don't see much emphasis on these reforms in the 15th five-year plan, sort of high-level documents that have been released to date. But there's huge potential here for China to lift consumption over the long term. And that's kind of where I'd end it. You saw the picture of the gradually downshifting growth, but still a big attractive market with strong fundamentals. If China actually pivots towards elevating consumption on a structural level, the upsides will be even better. And I think we could see even a reversal in that long-term downshift trend.
Thanks, David. Wow, it was really great insights you shared. I did have some questions in terms of maybe the productivity growth numbers that we're projecting over the next 10 to 15 years. So in the U.S., we've seen some improvements in terms of what we think might happen, and in China we've seen some improvements as well. To what extent do you think AI is going to be a factor in terms of the projections that we're making on productivity? I know that it is for the U.S. I know that there's a lot of government money, a lot of attention in the 5-year plan that is forthcoming on AI. How do you see that as a potential upside for Chinese productivity growth?
I think it's there, Eric, and it's pretty substantial. So China is really leading in terms of applying AI in a corporate setting. So in the US now, my feeling is we're seeing it mostly on the consumer side. There are all sorts of consumer and other AI applications that are interesting. In China, the focus is really on applying AI innovations to manufacturing, to the Internet of Things, to logistics and transportation networks, and so forth. And I think it promises pretty significant productivity improvements going forward and potentially a solution to the demographic problem that I outlined.
Thank you very much. And that'll be, we talked about that a little bit, Elena and I, in terms of the translation of some of this AI tech into manufacturing and in production, and especially in economies where there's sort of ongoing and intensifying shortages of workers. There's even more of an incentive.
I totally agree. That's what we see here on the consumer side, and we do need more on the manufacturing side, and that is still kind of in the nascent stage right here.
There's a lot going on here. It's very difficult to make predictions, but it certainly is fascinating. So,
well, the Chinese market is one that tends to experiment with things like these a lot more aggressively, if you will, not in an aggressive sense, but it's a market of scale where companies, foreign investors and Chinese companies alike, will trial new things in the market in a way they seem to be reluctant to do in the U.S. and Europe.
Well, we'll see. We'll check back in a year's time and see how this is developing. I want to spend the last 15 minutes talking about Europe. Dino in Brussels, thank you for staying a little bit late today and helping us here. What are we expecting to see in Europe? There's a lot going on there as well, and on the demographic front and policy front. What are you looking at for the remainder of this decade and into the next?
Thank you very much, Eric. I will also start, my section with the graph the previous presenters talked about. So the numbers you see here is basically the baseline scenario for the euro area economy, right? And what we expect annual growth from 2025 to 2039 to basically average around 1% annually in the euro area, which is a low number. And it's a low number because in our baseline scenario, we've made one very important hypothesis. And this hypothesis is that the kind of reforms that we talk a lot about in Europe, and which are very much needed to make the economy more competitive and more innovative and more productive, we expect efforts around these reforms to either stall or or to make limited progress, basically, in the over the next years. Naturally, if this is the case, growth should remain around this 1% level you see, and of course remain below potential. When we take things by component, the story for the euro area is very similar to the one we heard about, for China and the US. What I mean by that is that capital will remain the main driver of growth for the euro area economy. As you see on the graph, it will be the contribution will be around 1 percentage point over the next 10 years, higher than the 0.8 we had, during the post-pandemic period. Of course, this is because both companies will continue to scale up on defense and on digital investments, and at the same time, a lot of European governments will keep increasing defense spending. Another interesting story about the positive story about the economy is what happens on the TFP front. We talked a lot about productivity. The upside for the euro area here is that productivity will turn positive over the next 15 years, as you see on the graph. And this follows after 2 decades of basically TFP being a drag on growth. We expect this to happen because of higher digital investment, as I said, and the broader diffusion of the new technologies like AI. However, it's important to also note that the positive impact TFP will have on growth will be very, very limited. And I highlight 3 reasons why this is the case for the euro area. The first one is because what we see, according to the latest data, is that the rate of adoption of these new technologies across the region is very, very slow and very uneven by country. A second reason is the fact that, yes, digital investment will increase, but it will not match the scale or the magnitude of the investments we see in other regions like in China or the US. And a third reason is, of course, the fact that the European economy has persistent skill mismatches and skill gaps, especially in digital. And this, of course, if it were to continue, will dampen productivity dynamics. And then when we examine the labor input components, labor quality will continue to have a positive impact on growth. As you see, it's the yellow bar on the graph. Europe remains a home to, cutting-edge institutions, of course, and leading research, leading universities. So that's why we expect growth to continue to be positive on the labor quality front. But on the labor quantity will be the most major drag on growth over the next 15 years. And of course, the main reason why this is the case is not only because of demographic pressures increasing, but also because of what we see, the rise of more populist parties and across Europe is already leading to pro-migration agendas basically becoming less favorable. So this would be an overview about the region over the next 15 years. Again, absent reforms, the most important thing to note here is that growth, despite accelerating a little bit over the medium term, it will continue to, it will not sustain this momentum and could even reach levels below 1% towards the end of the forecasting horizon. Now, very quickly, if I could talk a little bit about what happens at the country level. I think the main story here is that we will continue to see very different growth paths when it comes to to Europe's four largest economies. When we talk about the next 10 years, what we expect the German and the Spanish economy will continue to drive most of the euro area's expansion. Of course, this happens for different reasons. The German economy has decided to follow a very ambitious expansionary fiscal policy. And I'm talking, of course, about the 500 billion euros fund that just very recently was approved by the German government, and which will have a positive impact on on the economy. The fund is this boost is for the sake of modernizing the German infrastructure and, of course, increasing the country's defense capabilities. At the same time, the Spanish economy, post-pandemic, was Europe's top performing economy. Growth has been broad-based and across all the main components of GDP, whether you look at private investments, consumption, government spending. So we expect the Spanish economy to maintain this strong momentum, at least over the next 5 years. Where the story gets a little bit, not as positive is, of course, in the case of France, and much less so in the case of Italy. So for the French economy, what we expect growth to remain close to 1%. And in our report, we highlight two reasons why this is the case. The first one is because of a massive fiscal strain that the French economy has to deal with. The French economy runs on a high deficit of 5.4%. They will have to address, this deficit, and of course, this will happen at the expense of spending and putting investments in other more productive sectors of the economy, whether this is the green or digital. Naturally, this will have an impact on the economy. And another key reason about the French economy is what happens on the domestic politics front. Since 2024, the country has been through a heightened period of political turmoil. If this continues, it will continue to erode, business confidence. It will continue to, it will stall any progress on much needed reforms, especially when it comes to public finances. And the most important thing, it will make it more difficult for French lawmakers to actually agree on, a multi-year, basically, fiscal consolidation plan for the French economy. And then Italy is the one that will be Europe's laggard, basically, over the next 15 years. It's interesting to note that from 2020 to 2024, the economy grew robustly by 1.1%, but this mostly happened because of cyclical one-off factors. And of course, I'm referring to massive funds received from the European Union. As these cyclical factors wane, growth naturally will accelerate, will decelerate, and this also happens because of a very acute demographic issue that the Italian economy will continue to face, over the long run. The very low productivity growth. Just to give you an idea, Italy is the only economy that productivity levels haven't even returned back to the levels they were in 2019. And of course, let's not forget that it's the country with the second highest debt. So demographics, low productivity, and a debt that is already quite high creates a very explosive mix, for when it comes to growth dynamics, and also for when it comes to debt sustainability itself, right? Let me talk a little bit about risks now. And one thing that is certain about the euro area economy is that downside risks will continue to outweigh the upside ones. And what is also interesting to note is that downside risks now, if they were to happen, or if they were to intensify over the next 2 or 3 years, are very likely to have long-lasting consequences for the economy. And it's a mix of both external risks, but also more domestic challenges. On the domestic challenges, we already talked about, the fiscal strain. We already talked about the political turmoil in key economies. On the external, of course, the number one issue is Russia's war and the possibility of spilling over to another, to a neighboring EU economy that is also a member of the NATO alliance. This would have devastating impact for the euro area economy, also because we have to keep in mind that the region isn't prepared enough to deter this type of aggression. Trade frictions will continue to matter, whether this is with the US or China. If they were to continue, they will have a detrimental impact to growth, mostly because of how important trade is for the European economy, and of course supply disruptions. If we have new incidents of supply disruptions, they will also have an impact on the European economy, given how much Europe relies on third countries and external partners, for inputs that are crucial to be used in its long-term objectives when it comes to the green, digital, and defense, of course. I want to be cautious of time, Eric. I would only like to mention one upside risk, if you don't mind. And of course, this is very well tied to what I said in the very beginning, which is, of course, the advancement on the competitiveness agenda. Assuming this happens, one key note we make in the report is that decisive reforms will have a positive impact on the economy, and this positive impact will be felt across most of the channels of growth that we study. Whether this is capital contribution, whether this is TFP contribution, reforms related to regulation, reforms related to a genuine savings and investment union that can help companies with their long-term investment planning and can make capital more attractive. And of course, policies when it comes to a better utilization of labor, so that productivity can improve. Assuming these things happen and these kind of policies happen at the EU at an EU level, then it's very unlikely. It's very likely that we can see growth from the low 1.2, 1.1% levels we have now. To maybe around 1.5, 1.6% for the next 15 years. And of course, this will help the euro area to not fall further behind compared to its competitor economies.
Thank you.
And I can stop here.
No, that was great. That was a great overview. I do want to also press to the audience that we have reports that dig into all the regions. We have a global report that kind of goes over the high-level stuff that I covered. Yelena's wrote a report on the U.S., which is on the website now. And Dino authored one along with Maria in Brussels. That will be posted, I think, on Friday. And then I know that the China Center report is almost on the website as well. So all of these sort of themes and numbers are sort of built into these documents. And we welcome you to download them and to read them in more detail. We don't have too much time for questions. There is one, maybe just quickly. I put Yelena on the spot. Sorry about that. It had to do with labor participation rates, whether or not they adequately capture new kinds of work.
Gig economy and things like that. Well, technically speaking, the household survey that the Bureau of Labor Statistics conducts, this should capture those things because the question in the household survey is, did you work over the period for pay, right? So, if you did drive an Uber or something of that nature and got paid, you should be captured in the part of the labor market, in the labor force. So theoretically, the answer is yes. The practicality of it is that the response rates are falling, and they're falling for pretty much everything. So it's a household survey problem and many other service problems. So the quality of data, unfortunately, could be deteriorating because of the low response rates.
And I don't think the U.S. is alone in that. Globally, I can't imagine that the labor force participation rates that I'm seeing in other economies adequately capture some of these emerging themes any better than is the case in the U.S.